hook. Did you know that in 2012, a single inventory mistake cost Walmart over $3 billion in lost sales? $3 billion gone. Just because the shelves looked full but the stockrooms were empty. That is the power and the danger of inventory. Welcome back. Today we are diving into one of the most important topics in financial accounting: inventory. By the end of this video, you will understand exactly what inventory is, how businesses track it, the different methods companies use to value it, how errors can destroy a company's financial picture, and why any of this even matters to you. Whether you are a student, a future business owner, or just someone who wants to understand how the business world actually works, this one is for you. Let's get into it. Section 1. What is inventory and why does it matter? Let's start with the basics. Inventory is simply the goods a company holds for the purpose of selling to customers. Sounds simple enough, right? But here is where it gets interesting. Not all businesses treat inventory the same way. A car dealership has cars sitting on the lot. That is inventory. A clothing store has shirts and jeans on the racks. Inventory. But what about a furniture manufacturer? They actually have 3 different types of inventory all at once. They have raw materials, which are things like wood and screws waiting to be used. They have work in progress, which is furniture that is partially built. And they have finished goods, which are the completed items ready to be sold. From an accounting perspective, inventory is classified as a current asset on the balance sheet. That means it is something the business expects to convert into cash within 1 year. When inventory is sold, it moves off the balance sheet and becomes an expense called cost of goods sold, or COGS. That transition from asset to expense is at the heart of inventory accounting. Here is the key formula you need to know. Beginning inventory plus purchases equals goods available for sale. Subtract ending inventory from that, and you get cost of goods sold. Simple formula. Massive implications. Now here is the question that keeps accountants up at night. When prices are constantly changing, how exactly do you decide which cost gets assigned to the goods you sold versus the goods still sitting on your shelf? That brings us to our next section. Section 2. Inventory cost flow assumptions. This is where inventory accounting gets really interesting and a little controversial. Imagine you own a shop that sells cooking oil. In January, you buy 100 bottles at $5 each. In March, prices go up, so you buy another 100 bottles at $7 each. Then in April, you sell 100 bottles. Here is the question: which bottles did you sell? The $5 ones or the $7 ones? In real life, maybe it does not matter. But in accounting, it matters enormously, because your answer changes your profits, your taxes, and your financial statements. There are 3 main methods accountants use to answer this question. First is FIFO, first in, first out. This assumes you sell the oldest inventory first. So in our example, you sold the $5 bottles. Your cost of goods sold is lower, which means your profit looks higher. Companies love FIFO when they want to show strong earnings. Second is LIFO, last in, first out. This assumes you sell the newest inventory first. So you sold the $7 bottles. Your cost of goods sold is higher, which means your reported profit is lower. But so are your taxes. LIFO is actually not allowed under international accounting standards, but it is still permitted in the United States. Third is the weighted average cost method. This takes all your inventory costs, averages them out, and applies that average to everything sold. In our example, the average cost would be $6 per bottle. Smooth, simple, and right in the middle. Same physical goods, 3 different methods. 3 completely different profit numbers. That is wild, right? But which method is actually better for decision making? Stay with me, because understanding errors in inventory will show you just how much is really at stake. Section 3. Inventory errors and their impact. Here is something that surprises a lot of people. A single mistake in counting inventory does not just mess up one financial statement. It creates a chain reaction across 2 full years of reports. Let's say your company accidentally overstates ending inventory by $10,000. What happens? Your cost of goods sold gets understated by $10,000. Because remember, that formula, goods available for sale minus ending inventory equals COGS. Lower COGS means higher net income, so your profits look better than they actually are. Your assets on the balance sheet are also overstated. 2 statements affected, 1 mistake. Now fast forward to the next year. That overstated ending inventory becomes the beginning inventory for year 2. Now your beginning inventory is too high, which overstates your COGS in year 2, which understates your profits. The error flips. Over 2 years, these errors actually cancel each other out, but in the short term, they can mislead investors, lenders, and managers in a big way. This is why physical inventory accounts matter so much. Companies often shut down operations for a full day just to count every single item in their warehouse. It is not exciting work, but the financial consequences of getting it wrong are very real. So now that we know how errors ripple through the statements, let us talk about a very important accounting rule that governs how we handle inventory values when things go badly. Section 4. Lower of cost or net realizable value. Here is a scenario. You are a retailer, and you bought 500 units of a product for $20 each. Then the market shifts. New technology comes out. Now nobody wants your product, and you can only sell it for $12. What do? According to accounting rules, you cannot keep that inventory listed on your books at $20. You must write it down to its net realizable value, which is the estimated selling price minus any costs to complete and sell it. This principle is called the lower of cost or net realizable value, often abbreviated as LCNRV. The idea is simple. Assets should never be reported at more than what they are actually worth. It is a conservative approach, and it is a core part of accounting ethics. The write-down is recorded as a loss on the income statement, which reduces profits in the current period. It is painful in the short term, but it gives a much more honest picture of the company's financial health. Hiding inflated inventory values would be misleading to anyone reading the financial statements. And speaking of reading financial statements honestly, let us talk about how inventory shows up when you look at real company reports. Section 5. Inventory on financial statements and analysis. When analysts look at a company's financial statements, inventory is one of the first things they examine. Why? Because it reveals a lot about how efficiently a business is operating. One of the most useful tools is the inventory turnover ratio. You calculate it by dividing cost of goods sold by average inventory. A high ratio means the company is selling through its inventory quickly. A low ratio might mean products are sitting unsold, which ties up cash and signals potential problems. Related to this is days in inventory, which tells you how many days on average it takes to sell all the inventory on hand. A retailer turning inventory every 20 days is in a very different position than one turning it every 120 days. These metrics are compared across industries and over time to spot trends. A sudden drop in turnover might mean sales are slowing. A sudden jump might mean a supply chain problem is coming. Inventory disclosures in the notes to financial statements also tell you which cost method a company uses: FIFO, LIFO, or weighted average. Knowing that helps you compare companies fairly, even if they report different numbers on the surface. Closing. So let us bring it all together. Inventory is not just a pile of products in a warehouse. It is a dynamic, carefully tracked asset that affects profits, taxes, financial ratios, and business decisions every single day. From understanding the 3 types of inventory, to choosing a cost flow method, to catching errors before they cause damage, mastering this topic gives you a serious edge in understanding how businesses really work. If this video helped you, do me a favor, hit that like button. It genuinely helps this channel reach more students just like you. Subscribe so you never miss the next lesson. And drop a comment below with your biggest question about inventory. I read every single one and might turn your question into the next video. See you in the next one.